Are you saying that right now the risk of a reinflationary kind of moment is greater or less priced into a market and more real than, say, a downdraft in growth?
Well, certainly it's less priced into markets. When you look at long-term inflation expectations, the expectation is for inflation to be at 2% or below 2% essentially forever. And given the geopolitical dynamics, given the Fed's easing into a relatively strong economy, given the fact that you still see a lot of sticky dynamics in inflation, particularly related to wages, which are showing some signs of reaccelerating. That whole picture doesn't really align with the probabilities of, a certainty around 2% inflation, and much more likely that we have higher inflation ahead rather than lower inflation.
Normally, somebody with that kind of view would be bullish, because if you believe in this sort of strong economy that could foster some reignition of inflation, that would be probably positive for equity valuations. But you wrote the stock market is priced to perfection. And so far, this quarter is providing plenty of data points that the perfection is unlikely to be achieved in reality. Why?
Well, I think when you're trading markets, you got to trade against what the price and expectations are. And we're at PEs that are, almost as high as they were during the tech boom. We have forward earnings growth expectations in the mid-teens. That's a pretty strong scenario, already priced into the markets. Now, the Fed is helping that along, and that's probably a positive. But I think the story is much more around being long stocks relative to bonds, because that's the scenario, of the growth reacceleration that probably isn't fully priced into the market.
Let's introduce China into the conversation. They're now exporting disinflation, perhaps even deflation. How do they factor into your worldview right now?
Well, China's experiencing debt deleveraging, akin to what happened in Japan and akin to
sort of classic balance sheet recession.
A classic balance sheet recession. And the policymakers there are maybe driven by motivations that are not related to macroeconomic policy, more like political motivations. And so for whatever reason, they're choosing not to respond to the situation. And so China's probably in this malaise for the foreseeable future. I think the effects on the West are actually relatively limited. And the reason why that is, China's deflationary impulse has been basically the same for the last couple of years. Probably China is not going to accelerate in terms of getting a deeper and deeper or a worse rate of deflation going on in the economy. And if anything, we've seen it tick up. And so the big picture is it's probably not the main story that's going on. When you're looking at U.S. inflation, Western inflation in general, what really matters, it's the labor markets. It's all about the labor markets. It's all about that wage data. If you look at the Atlanta Fed wage tracker data, we're 1 to 2 points above where we were pre-COVID. And unless you believe productivity has matched that increase, that's an underlying inflationary pressure that remains in the economy.
But, Bob, isn't the deflationary pressure coming from China has everything to do with the commodities market? Isn't that helping Western economies? Yeah,
it certainly is an effect on the commodities markets. And if you're trading, copper or other direct commodities that China has a meaningful share of, that's going to be a meaningful influence on that supply demand. But the flow through of that to the U.S. inflation picture, it's pretty tiny compared to rents, labor, the other sort of imported, imported goods costs that, cars, new cars, used cars, all of those things represent a much bigger impact on U.S. inflation and U.S. policy.